morning from our global headquarters in New York. I'm Menace Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. The bond market shock from down under. A hot Australian CPI jolts the global bond market as the ECB's Ollie Rehn sees 2 more rate cuts in Europe for 2024. A lifeline for Rivian, the EV maker, and Volkswagen plan a $5 billion joint venture to catch up with Tesla. And just one day away from the first Biden-Trump debate, we sit down with Adam Posen of the Peterson Institute later this hour to debate policies. You could say it was saving private tech yesterday. Nvidia rallied, and it's up again this morning, up 7% yesterday. So again, unknitting some of those jangling of the nerves that you had of the 3-day crash. But this move in the S&P 500, it's the second weakest breadth in a century. So yes, Nvidia rallied and the chips rallied, and you go, yes, we're back on the upsweep. But the breadth of this market is the second weakest in a century. It was only beaten in October 2023. Neuberger Berman, Mr. Steve Wiseman says he's long a lot of chips. A couple of other stocks that you've got to keep your eyes on. There's Nvidia up 2.5%. But look at Rivian. I mean, if you're looking for a lifeline to stop the hemorrhaging of cash flow, to change the direction of the narrative of your stock, hand it to VW. A symbiotic move. They get the tech. Rivian gets a lifeline. Let's see, does it endure? Today, you got 5-year paper coming down the pike. The 2-year bid-to-cover ratio yesterday was pretty solid, 2.75, $70 billion worth of 10-year paper today. Keep an eye on the curve. I still put it to you, it was the most inverted since December of last year. That inversion is bearing a little bit more prescience at the moment. The euro-dollar is down. Ollie Rehn has spoken. There's no reason why he doesn't see 2 more rate cuts this year and a terminal rate next year of around 2.25%. The euro is down on the back of that. So keep an eye on breadth. That's probably the most important issue for you. But we talked about the bond market and an 18 basis point move so far in the Aussie rates. Now, this is where you begin to understand the jolt from down under. Australia's inflation accelerated at the fastest pace for the 3rd straight month in May. That boosts the bets that the bank is going to have to actually raise rates. Ven Ram is with us. So, Ven, leave it to the Aussies to jolt the global bond market.
Absolutely. I mean, the market went into a tizzy this morning after those inflation prints because, this narrative has been coming for some time now. If you look at it, it was the 3rd successive print when inflation has accelerated. Now it's at 4%. And if we get a quarterly reading, which is more important from Australia's perspective, then that will cement expectations for a rate hike. If you look at the Australia's benchmark rate, we are at 4.35. So the real policy rate is too slender to be restrictive at current levels. So the RBA is acutely cognizant of this. They already said earlier this month, they reintroduced language saying that they will do what it takes to break inflation. They also said off the record, i.e. it wasn't in the statement, that look, they discussed a rate hike explicitly earlier this month. So what this inflation print does is bring alive the prospect of a rate hike in the 3rd quarter.
And certainly the reaction function is there in high beta currency. You've got the Aussie up 0.4%, and those rates, that has jangled the rate nerves across the world. By the way, Adam Posen is with me a little bit later on. He says 80% probability of a rate hike from the Fed next year. He's way out on the left tail, and that consensus is not what we're seeing in the options market, is it? Because, I mean, this is incremental. We've seen a couple of these trades go through on Friday and on Monday. But this story is building momentum. There's somebody out there punting on 300 basis points of cuts from the Fed by March of next year. Now, this is in the options market, isn't it?
Yeah, absolutely. I mean, I think that's more of a hedging trade, Manas, because, the bulk of the portfolio managers are positioned for rates to go down gradually. They've seen since the start of the year when the markets were pricing oodles of rate cuts. That's not happening. And if you look at the resilience in the U.S. economy, and if you look at the resilience in the jobs market, I don't think we are going to get 300 basis points of cuts anytime soon. So that is a kind of a tail risk hedging trade that portfolio managers have overlaid on their portfolios just in case things go wrong. They were looking for an option that will pay out, and that's what the trade represents. It's not the base case scenario. I would take it with a pinch of salt.
I know. Well, it's a small options trade, but it makes a beautiful headline, and it's one of the most read stories on the Bloomberg terminal. It just keeps compounding itself, Ven. That's how desperate we are for a narrative on rates. Ven, good to see you this morning. Ven Ram on the Aussie rates jolt. To the narrative around AI, let's stick with that, because the Fed president of San Francisco, Mary Daly, had this to say last week about her excitement around AI.
I think of AI as potentially being a great leveler, leveling the playing field, democratizing the expertise by giving people a hand up or a leg up in terms of starting.
It's a productivity boost. We're all wondering when it will be delivered and in what size. Our next guest writes this: AI outperformance is likely to continue for some, but I think we are at the early stage of next year is when the shoe will start to drop. There simply isn't the demand for all the AI architects' output at this stage. Heresy. Sophie Lund-Yates, head of equity analysts over at Hargreaves, Lansdown. It's good to hear a voice that questions the narrative, the scale. You would say that we are entering a new phase, and that new phase may not be as effusive on chips and tech as the market presumes. Why the hint of skepticism, Sophie? Good morning.
Hi, good morning. Yes, I know not too many people necessarily agree with this. So, what I'm not saying is that, AI demand is about to fall off a cliff, but simply the scale at which we are seeing capacity being built. How long can that be sustained and met with the appropriate level of demand that the market is currently pricing in? Particularly, I think, as we look towards the end of this year in particular, I absolutely don't see anything upsetting the apple cart. But really, for me, I think realistically, when we start to get to Q1, maybe Q2, kind of the midpoint of next year, is when investors are really going to want a lot more granularity and understanding of those outlook statements in particular. And really, for me, it is simply, as I was saying, it's this scale of capacity ramp-ups that, yes, it's necessary right now because demand is outstripping that capacity. But I do see a situation where actually that starts to flip, because a lot of the AI plans that a lot of names have, they're a little bit woolly, right? We don't actually know fully what the demand scope is going to be when we start to push out to the medium term. And that is simply something and an uncertainty that I don't think is currently priced in. Well,
then how do I position for that? Because if I'm to step out, shave back, trim back, I miss out on the upside, don't I? So positioning-wise, do you remain long and broadly long within chips, within tech, within semis, but you reflect on that as you go towards the end of the year?
Sure, absolutely. I think that we're in a situation where absolutely you still need to maintain some exposure to chips in particular. Certainly, I don't think we've necessarily reached the North Star of NVIDIA yet. It's not going to be a straight line. We're going to see some bumpiness there. Yeah. But I don't think that the peak has been reached. So absolutely don't ignore big tech and chips in particular in my perspective. But I do think that it's time to start looking at some profit taking and therefore pivoting to some other areas of the market. And dare I say it, potentially outside of the US, particularly Europe and the UK has some compelling options. So not a total overhaul of portfolios, but I would say certainly some profit taking would be sensible. And yeah, start looking to other shores, as it were, not to be too poetic.
No, not at all. And I was at the Bloomberg Investment Conference yesterday here in New York, and we did a poll, and only 19% of that audience wanted international exposure, and most of them still wanted exposure to alternatives. There's a couple of other individual stock stories which I'm curious to get your view on. We've got the Rivian deal. I mean, one could call the Rivian Volkswagen deal symbiotic and poetic, or it could be just a desperate lifeline for Rivian. How do you view it?
Sure, it is a lifeline for Rivian, and I think really it's really important not to get too carried away, because yes, okay, when you're looking at this 30-40% move in the share price that we've seen, okay, great, that of course is good news for investors. But when you start seeing moves of that magnitude for a company that is loss-making, that doesn't tell me that this is time for celebration. That tells me the scale of the stress that was in the price. This is a huge sigh of relief, really, rather than a cause for celebration. Yes, it's good news. We know that the EV market, long-term wise anyway, is certainly something that's meant to be, it's going to be very prosperous. But it's, is $5 billion enough really for them to meaningfully rival what Tesla is doing, and particularly some of the players over in China as well. So certainly, I'm not going to knock this deal. It's certainly a step in the right direction. But I would far rather see some stronger fundamentals coming out of the group. But I would say that because I'm old school.
No, there's nothing wrong with questioning it. Rivian has had a challenging time. Look, we're trying to sort of gallop through a whole host of issues, but I am curious to get your take. The reinvention or the representation of Nike in China is something that we're going to learn a little bit more about in some of the numbers. China used to be 20% of their market. That's down to 15%, and they're betting large on $1,000 sneakers and cashmere products, etc. Just talk to me about how important it is to regain that 5% market share that they've lost, because of course it was a lot of discomfort for a lot of companies around Xinjiang in terms of the labor forces there, the cotton used there, and this is in part which caused the dissipation for Nike in China.
Yeah, sure. Certainly a big set of results for Nike due tomorrow. Really, that 5% market share for me, the recapturing of that in China it's not unimportant, but it's certainly not the primary focus for me. I'm more focused on really how they are positioning their wholesaling specifically, and also more broadly their own branding, right? On a broad scale, international scale is not doing what it needs to be doing. When we look at the branded sales, digital sales, falling 3% last time we heard from the group. That needs to start reversing, and it's a deep-seated innovation and pipeline problem that they are facing that they need to fix. So really some clearer granularity around how that's going to be resolved. But certainly a clearer roadmap for fixing the problems in China wouldn't go amiss. But I think that there is some, as I say, some deeper rooted innovation problems that need to be fixed at the group level.
Sophie, good to hear the calls for detail on every front, from AI to Nike. Good to have you with me this morning. That is Sophie Lund-Yates of Hargreaves Lansdown. And tune in to more interviews today from Bloomberg Invest throughout the day. We've got the Lazard president, Ray Maguire, and the CEO of Ares Management joining the lineup. Other stories trending on your Bloomberg terminal this Wednesday morning in New York. Nomura's trading head, Christopher Wilcox, got a $12 million comp. That's more than triple the CEO's pay and the highest pay ever for a top executive at Japan's brokerage after the company returned to profitable growth. Norway's largest pension fund has exited its stake in Caterpillar. The fund cites concerns that the company has been contributing to human rights abuses in the West Bank and Gaza. Caterpillar wasn't immediately available to comment. China discovered that officials allowed cash raised from special bonds or funds from the central government budget to be invested in subpar or halted projects. Now, the revelation raises questions about the effectiveness of the current fiscal measures in bolstering the economic recovery. Coming up, we'll delve deeper into the EV market in flux, as we've just said. A JV of $5 billion. Is it enough of a lifeline for Rivian? The details on Bloomberg. And later this hour, we will count down to the first US presidential debate with Adam Posen of the Peterson Institute. Context matters on Bloomberg. Good morning. It is Bloomberg Brief. I'm Manus Cranny in New York. A very good morning. Let's talk about one stock that we're tracking. It is Rivian, the EV maker, surging after announcing a $5 billion joint venture with Volkswagen. The deal allows VW to get access to the startup's tech, and that's in exchange for much-needed cash infusion. Monica Remont joins me now. So this is an interesting deal. It's Rivian. It's either a symbiotic deal or one of desperation. So how would you contextualize? Let's go for the upside first of all. What does VW get out of this? Does it really give them a jump start in battery technology, in EV technology?
Yeah, Manus, I think that's an excellent analysis, to be quite honest. Volkswagen has really struggled to get its software game off the ground. It has an in-house software unit named Cariad, And CARIAD has really struggled with the next-gen technology, the next-gen software that the car maker really needs to really compete against Tesla and some of the incoming Chinese electric vehicles. Now, this deal with Rivian, that is going to give Volkswagen access to Rivian's current next-gen technology so that they can implement that technology, that software, into their next line of electric vehicles. And I think that's the main benefit that Chief Executive Officer Oliver Blume wanted to emphasize in the call that he held last night with media and with other stakeholders. He really said this is about the next generation of software, and it's about them preparing for that next wave of models.
And I suppose, what does it mean for Volkswagen's push to revive the Scout brand with electric trucks and SUVs in the Scout Motors project?
Yeah, that's an excellent question. I think that's sort of the looming question in the minds of a lot of analysts and investors. Volkswagen announced recently that it was going to be pushing forward with the resurrection of the Scout Motors brand to sort of electrify, to offer a more electrified offering when it comes to trucks and rugged SUVs. Now, Rivian is presumably offering something very similar. They're kind of overlapping in terms of what their model portfolios look like and in terms of what their brand identity and brand values are. A lot of analysts are sort of questioning whether or not this means that Volkswagen is sort of hedging its bets or what it means. Volkswagen, for its part, has said there is no change to their aspirations when it comes to Scout Motors. They've said officially we are moving full steam ahead on this. Volkswagen has actually already broken ground on the Scout Motors plant in the United States, and there's even talk of Audi using that plant in the future for its electric vehicles. So full steam ahead on Scout.
Full steam ahead on that, as you say. There is a benefit on the tech side. Monica, thank you so much for being with us. Monica Raymond, tracking the Rivian story. Coming up, Julian Assange walks free and in a 14-year legal drama. Your front page news on Bloomberg. Context matters from New York. Good morning. It's Bloomberg Brief. I'm Manus Crenny in New York. Let's get you up to speed with the front pages. What is making headlines around the world? First up, Bloomberg. Julian Assange walks free after pleading guilty to leaking U.S. national security secrets. Assange is due to return to his native Australia later today. Next up, the secret trial of the Wall Street Journal reporter Evan Gershkovich began in Russia today. He denies accusations of espionage. Russian trials almost always end with a conviction, which could pave the way for a possible swap with the U.S. New York Times leads with Representative Jamal Bowman lost re-election. He's a member of the House's left-wing squad. His challenger was boosted by record spending by pro-Israel groups. And also here in New York, the leaders of finance gathered downtown in Manhattan for the Bloomberg Invest Conference. I went there yesterday after the show. I caught up with Columbia Investments' Kim Liu and CPP's Edwin Cass. Let's take a listen.
If you just focus on the U.S. markets right now, we used to have 8,000 stocks in the public market, and now we're down to 4,500 stocks in the market. And I think it's something like 87% of companies with sales over $100 million are private. So I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set. I think that the way we think about investing in private markets and the way we approach it is different than you might have done in public markets. I often say, we joked about it, that public markets is dating and private markets is getting married. And so you have to approach it and you have to do it very differently. You have to be thoughtful about these relationships because, for sure, if it doesn't work out, you have kids together and you have to figure out how to manage those relationships. And so I think that being thoughtful about how we engage in the private markets is increasingly a pressure among private investors, especially now that interest rates have gone up. I've been in this business long enough that these rates don't feel so high to me, but it does feel extremely high to my team. And so trying to pay attention to how the valuations have to reset before, once again, we can make a lot of money. But I have high hopes that we will continue to make a lot of money in the private markets.
When we think about public versus private markets, the first question for me is, do you get any kind of diversification by going into private markets, diversification benefit? And for most private assets, we think they load on generally the same kind of factors that public assets load on. So if you think of private equity to us is like levered small cap. If that's true, then you're really not getting a diversification benefit. You have to look to something else, and that something else has traditionally been alpha. And you can think about all the different sources of generating alpha from private markets, whether it's origination networks or value creation plans or just the ability to kind of pick better securities through access to private markets. And we think there's still a positive expectation in terms of the comparative advantages that we've built up to invest in private markets that gives us an impetus to push into the asset class. But I think there's one really interesting feature that's going on right now, and obviously you alluded to the start, is kind of NVIDIA and what's going on with NVIDIA. To the extent you're diversifying into private markets, you're getting away from public markets, you're getting away through the ability to access some of those huge growth engines like NVIDIA. And the one thing we've been challenging ourselves lately is, could you predict that this was going to happen? Or how would you protect yourself against this happening if you didn't have that kind of exposure? Generally, concentration in a market, in a portfolio, of course, is really bad. But there's also this big kind of winner-take-all theme going through the markets right now. Does that persist? And do you think the conditions exist right now that can kind of feed off itself?
Columbia Investments' Kim Liu and CPP's Edwin Cass sitting down with me yesterday at Bloomberg Invest. More to come from that. And you want to check out our inaugural monthly issue of Bloomberg Business Week. The cover, it's an exclusive interview with one of the richest people in the world, the LVMH founder, Bernard Arnault. It's a monthly magazine. From our global headquarters in New York, a very good morning. I'm Manish Cranny. Let's set your agenda. A bond market shot from down under. A hot Australian CPI jolts the global bond market as the ECB's Ollie Rehn sees 2 more rate cuts for Europe in 2024. A lifeline for Rivian. The EV maker and Volkswagen plan a $5 billion joint venture to catch up with Tesla. And just one day away from the first Biden-Trump debate, Adam Posen joins me from the Peterson Institute. That's next. Very good morning. So, saving private tech is the narrative. NVIDIA came back from a fairly brutal 3-day sell-off, rallied by 7%. We certainly haven't seen the North Star, according to Hargreaves Lansdown this morning. However, they are skeptical in some ways of the Rivian deal, which is a joint venture with Volkswagen. Rivian roaring ahead by 36%. However, again, Hargreaves Lansdown make the point, this is a brutal reality at Rivian rather than something to triumph. It really speaks to the pressure that Rivian is under. By the way, in terms of breadth, stocks are up by 0.2%. This was the second weakest rally this century. So just bear that in mind. 113 S&P stocks rallied yesterday, the second weakest breadth on record. Rivian is bid this morning, as you can see. The bond market, you had your 2-year paper yesterday, bid to cover ratio of 2.75. 70 billion of fives come down the pike today. Inversion is still very much a prescient theme in the bond market. You've had that little bit of a jolt from Australia. It certainly moved Aussie rates quite aggressively along with Kiwi and Japanese rates. You are just seeing a little bit of a knock-on effect here in the first instance for the US. And Ollie Rehn says that, never mind political pain for the euro, he sees 2 more rate cuts this year. The euro dropped a little bit on that, down 1/8 of 1%. He sees that as being a reasonable supposition. So that's state of play on the equity markets. The countdown to the first presidential debate is on. We are barely a day away. Presidents Biden and former President Trump go head-to-head on Thursday night in Atlanta. Trade, tariffs and immigration will top the agenda. The team over at the Peterson Institute highlight the risks of a material shift in the immigration policy, writing this. We believe that a Trump administration will attempt to deport at least 1.3 million U.S. resident workers. The number could hit as high as 7.5 million, according to former President Trump. I'm pleased to say that the Peterson Institute President Adam Posen joins me now. Adam, good to have you with me this morning. I mean, those are bold numbers either at the bottom or at the top. This is very reminiscent of what Trump promised in 2016. He talked about 11 million illegal immigrants and that they would all be gone. Put in context for me these numbers that you're putting out there.
Yeah, thank you, Manus, for having me on again on the Bloomberg Brief. This is a really important topic. What we did in 2016 and what we're doing right now is we're taking seriously and literally the statements of both presidential candidates and trying to assess what they say. President Trump, former President Trump, has said repeatedly two sets of numbers. One is to get rid of so-called all the people, undocumented aliens in the U.S. workforce, and that's a number of 7.5 million. However, what he, and importantly, his surrogates and the campaign have repeatedly said are two things. First, this will be the largest deportation in U.S. history. The deportation in U.S. history that was largest was the 1950s Eisenhower removal of the Operation Wetback, as it was hatefully called. And that was 1.2 million people. Another of his surrogates has said repeatedly that they will deport everyone who has a deportation order at present. That's also about 1.2 million people. So we believe it is entirely likely he will actually do this. He has the executive authority to do this. What you just flashed on the screen is analysis by Warwick McKibben, Marcus Nolan, Meg Hogan from the Peterson Institute of what this would mean for the economy. So leaving aside the human issues, the implementation issues, and what this would mean for the economy is a manufacturing-centered recession. And inflation would go up, so it would actually be stagflation, but the inflationary effects would then be outweighed by the recession.
Adam, can we just pause for a second? Because I think there's a lot to unpack there. As you say, it's both headlines and outcomes. Can I just push back a little bit and say, look, what is different now in 2024 that makes you believe that this president will be able to deliver those kind of numbers, even at the bottom end, Adam, would be quite radical for services, inflation and growth? Because the promises were made in 2016 and they were not very effectively delivered because state and local authorities did push back. So is it materially different now?
I hope it is. I mean, I hope it isn't. I mean, it would be great for the U.S. economy if it turned out that this was just bluster. But the point is, legally, the president does have the power to do this.
Okay.
And additionally, there is precedent in the recent past in the U.S. for deporting 1 million people.
Okay, so these numbers are real and can really grow. You talk about the growth in the inflation, and we just showed those numbers, and they are quite staggering in terms of the potential effect, even at the lower end, Adam, over the next 3 years on growth and on inflation. I mean, a radical jolt in inflation. So Larry Summers, we'll talk more about that in a moment, but if this kind of deportation takes place or immigration shift in policy takes place, can it invoke the mother of all stagflation?
I believe it can. I mean, certainly that's the direction, Manus. It's a contractionary force on growth and manufacturing output and employment, because the point is, as we've seen over the last few years, in the last 20 years, migrant labor is a complementary input to U.S. labor. They do jobs, for the most part, American natives do not do. They are cheap labor that enables firms to hire more other labor. They create demand. So a removal of labor supply, which is what this is stagflationary. It increases the price of available labor and it decreases the availability of labor. So I agree with Larry. This would be stagflation. You can see that in the chart your team's now putting up, that we just had this jump in the labor force while unemployment remained extremely low and growth went up and inflation came down. Now, there are a bunch of other moving parts in the economy,
of course,
particularly on the inflation front. Something could offset this, but it is a stagflationary impulse to the economy.
Look, I want to try and tie together because, again, if I look at some of the policies that are being espoused at the moment, we'll maybe find out a little bit more about how dug in Trump is on tariffs. Biden has continued a lot of those tariffs. But if we look at that, 60% tariffs on China, 10% tariffs on the rest of the world. Again, if I take the immigration narrative that you've done some work on, the potential for tariffs, again, this takes us back to your call, which is by next year, I think you're putting down there an 80% chance that the Fed will hike by the end of the third quarter in 2025. Is that in part, Adam, co-joined with these two narratives?
Yes. And again, thank you, Manus, for stitching it together. So I believe there are 5 reasons why we're going to have inflation sufficient that by a year from now, the Fed's going to be hiking. One of the reasons, and the biggest one potentially in terms of size, is this combination of tariffs and anti-migration policies if Trump were to win. But as you note, fairly, the Biden administration seems to be intent on not rolling back anything that the Trump administration has done so far, and they did just reverse themselves partly on migration issues. So there will be some inflation impulse, even if it's Biden, it'll just be smaller. But there are a bunch of other reasons why inflation, I think, will be up in a year. One of which is there's going to be fixed fiscal spending on defense, industrial policy. Another is that there's going to be threats to Fed independence, specifically if Trump wins, not if Biden wins. Another is that the Fed is just not as tight right now as it thinks it is, and we can see that in the financial markets.
Now, obviously, as you say, it's not just a Trump policy. There are Biden policies as well that can be provocative to inflation. So then extrapolate your left tail call, because you're not consensus. What kind of series of hikes could you imagine, even in a tamer political immigration, inflation, tariff world? Are you talking about rates at 5%? Are you talking about rates at 6%, 7%? What kind of extrapolation could we expect?
I think if we get Biden, again, there will be mild inflationary pressures because there will be incremental changes to China tariffs and incremental restrictions on migration. I think the fiscal laxity will be there. The Fed independence threat won't be there. The huge labor shock won't be there. So I think you'll get mild inflation, which means the Fed is simply going to probably have to do a whiff of gunshot and raise once or twice, possibly 3 times in 2025, second half. If instead we get Trump, and if, as you point out, he actually does what he says he's going to do, which he legally and politically can, and there's no, if he doesn't, great. But if he does what he says he's going to do, then the Fed's on an extended hiking path of well over 100 basis points in the second half of 2025, in my view.
And it's a worthy view to have. I don't know what you do, Adam Posen, when you turn up on Bloomberg Brief, but you provoke red headlines on the Bloomberg terminal about dollar-yen. So let's just park the Fed, the rest of the theoretical here, because I want to go to dollar-yen. Dollar-yen weakens to 160, raising the concerns of, you got it, intervention. I think the last time, I'm going to paraphrase aggressively and sort of from Wall Street. You know, you talked about throwing peanuts at the gallery of intervention thus far, which was 60 billion the last time round. I mean, Adam, where are we on this debate? Because here we are, we've had jawboning again this week on dollar-yen. Can we just stand back from this for one moment rather than get caught in the headlight of 160? And talk me through the error that would be if they do not intervene in size and scale. And maybe you might contradict me and say, Manus, they don't need to. Tell me.
They have to make up their minds what they care about. And the Bank of Japan has, with some justification, said the exchange rate is really not our issue because the exchange rate is not causing major changes to headline inflation or to growth in Japan. The Ministry of Finance and the Prime Minister's office care about the exchange rate. And so ultimately, though, they set exchange rate policy, but they've got 2 headwinds working against them. One is, for all the jawboning, the U.S. government has not come out in jawboning saying they want the yen to rise. It's just been the Japanese government. And 2, the interventions would have to be, as you say, and we discussed last time I was on, have to be on an enormous scale akin to what the Chinese scale was in 2015, which is hundreds of billions of dollars. So I think it's now just a question of managing the downward descent of the yen rather than changing policy. They're not going to be able, with intervention alone, to stem this, I think.
Do they have the stomach for hundreds of billions of intervention?
I would hope not, frankly. I don't know. They have the reserves. The reserves aren't doing anything useful, but spending the reserves on defending the currency also isn't the most useful thing for Japanese well-being. So I'd rather they talk about either a path upwards for the interest rates in Japan with some pre-commitment that would affect the yen, or they talk about supposedly not caring much, in which case the rally in dollar versus yen will run out of its own accord.
Okay, it's like the flame that burns itself out. Adam, thank you very much. A, for getting up early, B, for the paper, and C, for sort of going left field with dollar yen. I don't know what you do, but you invoke the move in dollar yen. Adam, thank you so much. That's Adam Posen.
Thank you.
The Peterson Institute of International Economics. Their call on immigration policies and dollar yen. Coming up, signed, sealed, delivered. FedEx exceeds expectations as cost-cutting plans take effect. Context matters on Bloomberg. It is Bloomberg Brief. I'm Manus Crenny in New York. Stock in Rivian extends its double-digit gains after announcing a $5 billion pact with Volkswagen to develop the next generation of EVs. Monica Raymond is with me. Monica, you know, the winning trade here is maybe for Volkswagen. That stock is lower. Or is it a desperation trade by Rivian?
I think it's a little bit more complicated than that, Manus. This deal is going to see Volkswagen, through a JV with Rivian, get access to Rivian's next-gen software, and that's going to help Volkswagen as it tries to ramp up its portfolio of electric vehicles and compete with Tesla and incoming Chinese competitors.
OK, let's see whether that comes through with Hargreaves Lansdown a little bit earlier today. They were slightly more sceptical on the Rivian side. Monica, thank you very much. Short and sharp. Rivian is up 35% this morning. Volkswagen a little bit less enthusiastic about the deal. Another stock that we're tracking is the double-digit gains from FedEx. The carrier's profit forecast surpassing the expectations on signs of a sweeping plan to reorganize, cut costs. It's proving effective. Lee Klaskow joins me from Bloomberg Intelligence. Lee, good to see you. Look, this is a mighty rebound in the stock. Do you think, you know, this will continue? What are they doing right that the market really, really likes?
Well, the big shock, I guess, from the earnings release was the information about them putting their freight business, which is their less than truckload business, up for a strategic review. LTL carriers or less than truckload carriers tend to trade at a much higher multiple than a carrier like a UPS, FedEx, or a DHL. And so management is looking to possibly unlock that value. That could come in as a sale or maybe a spinoff. We think that the odds of a sale, at least a strategic sale, might be a little difficult because in the LTL world, if two national carriers get together, it's really hard to extract synergies. So maybe it might make sense for more of a spinoff. But, you know, investors are pretty excited about that possibility, and that's really one of the reasons that's pushing up the shares. Also, management is executing on their strategic plans, their drive plans, which generated around $1.8 billion in permanent cost savings last year in their fiscal 2025, which begins this month. You know, they expect to generate another $2 billion in permanent costs. They're also, you know, in the process of kind of combining their ground and express networks. They're going to do that in Canada next, and that should be a big undertaking. And a lot of eyes will be on, you know, how successful that is and how well management is able to execute on that plan as well.
Look, we're dealing in a post-COVID world with what it is for transport. We're seeing the squeeze, as it were, in the airline industry. We're seeing margins rise there. If I talk to you about this world that FedEx lives in, you know, how strong are those margins? They did a reasonable size buyback as well yesterday. I mean, the competition in this space, how tough is it?
Well, you know, to your point with e-commerce, you know, things are changing. So, you know, there's more of a mix of business to consumer shipments in their network. And those shipments tend to have higher costs because delivering one package to your doorstep is a lot more expensive than delivering 50 envelopes to a lawyer's office. And so, you know, what FedEx and UPS and DHL, for that matter, have all been trying to do is reorganize their networks to deal with the new realities of these higher costs. So it's really about extracting costs.
And depends on how much more they can actually do. I mean, they've been fairly successful at that so far. Lee, thank you very much. The stock has certainly had a beautiful run overnight. That is Lee Klaskow of Bloomberg Intelligence. Now, Micron is set to report their results after the market closes today. Analysts expect a strong report from the memory-focused chip maker. Joining me now to take a walk through the preview is Jake Silverman, semiconductors analyst for Bloomberg Intelligence. Jake, good to see you this morning. I mean, there's a lot of optimism around this whole sector. I mean, yesterday I said it was like saving private tech, saving private chips by NVIDIA, but yeah, that was more an idiosyncratic day. This stock is up 60% on the year. What is the foundation for that success apart from sector run?
Yeah, so it's primarily been driven by pricing strength throughout the year. And a lot of that came from pretty severe capacity reductions, CapEx cuts in 2023 following a particularly severe downturn. And so as demand has sort of stabilized, it's begun to recover across smartphones, servers, PCs. We're now starting to see pricing continue to increase, and there's a lot of optimism that will continue throughout 2024 and into 2025 as well.
I mean, the chip makers are great, aren't they? They're either famine or feast, and it's sort of like it's over feasting. And then they have to do these dramatic drawdowns. If I said to you, can the momentum, I mean, there is a new momentum in the overall AI chip and memory business, full stop. Sophie from Hargreaves Lansdown, a little bit more skeptical about whether this will really come to fruition in 2025. So the question would be is, can the momentum continue for Micron into 2025? The complexion of their customers, how stable is that trajectory?
Yeah, so there's a couple factors to sort of think about. First and foremost, high bandwidth memory is probably the most important product right now that Micron and peers supply into AI infrastructure. And high bandwidth memory is pretty capacity constrained right now. So suppliers are actually working really hard to increase that capacity to keep up with demand. And as long as hyperscalers are continuing to invest in this space, as long as CapEx continues to increase quarter to quarter and into 2025, we're not overly worried about any particular slowdown right now. They're really focused on building the best models, building a lot of models.
And how, we spent a lot of time talking about GPUs and AI chips and new developments, and every so often Jensen Huang, the godfather of AI, stands up and holds up a nano and talks about the size and the scale of chips. But where are we? What are the implications for Micron and their peers in this race? Yeah, so HBM is sort of an interesting secular catalyst. We haven't really seen this much in the memory industry, at least not in a very long time. And the complexity of the manufacturing of HBM and the fact that it is so supply constrained has led to pretty strong pricing premiums relative to standard memory, even up to 9 times compared to the most recent spot pricing for DDR4 when I look at HBM3E, which is being designed into NVIDIA's Blackwell GPUs. So it's a pretty important product, and that will lead to margin expansion. As long as it continues to grow as a percentage of bit share for Micron and peers, it should lead to margin expansion over time. Jake, thank you very much. Getting up early. Let's see what the numbers deliver later today. Jake Silverman, Bloomberg Intelligence on Micron. Context matters from New York every day on Bloomberg. Good morning. Let's check out what we've got on the slate for you today. U.S. home sales hit the tape at 10 a.m. Eastern. Treasury auction, $70 billion of paper. The twos went fine yesterday. $70 billion of 5-year paper today. And as we just discussed with Jake, you got the Micron numbers coming down after the market close. That is certainly going to be one to watch overnight. We've got this bid to chips this morning on the back of NVIDIA. The surveillance team will pick up the baton. That's it from the brief team. A very good morning. Context matters on Bloomberg.